the psychology of money.
Yes.
We've got some amazing articles, books, all sorts of stuff.
Oh, cool.
Really gets to the core of why we, you, me, everyone, makes the financial decisions we do.
Right, because it's not always logical.
No.
It's emotional.
Exactly. Forget the spreadsheets for a second.
Yeah.
We're talking about the human side of money.
The messy side.
Yeah, the irrational, messy side. How we deal with wealth, risk, happiness, the whole thing.
It's funny, isn't it? Like health and money, these are two things that affect everyone.
Yeah, totally universal.
But we approach them so differently.
Screw.
Health, it's all about science, data, research.
Right.
But money.
Yeah.
We get these rules, formulas, like it's some kind of...
Like physics or something.
Yeah.
Like it's set in stone.
But is it really that simple?
I don't think so. I think that's what we're trying to figure out here.
Yeah.
To really dig into those emotional, experiential aspects of money,
I like that.
Because we often miss that part.
Right.
How our feelings are passed, all these quirks we have, they really shape whether we're financially secure or always struggling.
Yeah. So where do we even begin with this whole psychology of money thing?
Well, I think a big part of it is understanding the power of your own personal history with money.
Oh, interesting.
Like your experiences, even the small ones, shape your view of money way more than any book or expert.
Yeah, that makes sense.
Yeah.
I mean, someone who grew up during a recession, they're going to be way more cautious.
Yeah, totally. They'll save more, be careful with jobs, that kind of thing.
Versus someone who's only ever known a booming economy.
Right. Their outlook is going to be completely different.
Totally. Like two different worlds.
Yeah. Or imagine someone who grew up poor, right? Their idea of financial risk is going to be so different from someone who grew up rich.
Oh, yeah.
Even if they're both super smart and informed now, their core beliefs about money are miles apart.
Yeah, it's deep.
It's those early experiences,
Yeah.
They shape us in ways we don't even realize.
Right.
Or think about inflation, for example. Someone who lived through like the crazy inflation of the 70s, early 80s,
Oh, yeah.
they understand it viscerally,
They've felt the pain.
Yeah, it's in their gut. But someone born later, they might only understand it theoretically.
It's like you can read about history, but it's different to actually live through it.
It is. Like Michael Batnick, this investor, said, some lessons have to be experienced before they can be understood.
Totally. You can't just study the Great Depression,
Well, you can't.
You can't replicate that feeling of losing everything.
Exactly. That fear, the uncertainty, that sticks with you.
Yeah. And this isn't just like a theory, right?
No, it's not.
There's actual research on this.
Absolutely. These economists, Malmendier and Nachel, they looked at tons of financial data.
Okay.
And they found that people's willingness to take risks, it was tied to their personal history with the economy.
Interesting.
Like had they lived through recessions, booms,
Right.
And it wasn't as much about their IQ or education.
So it's really the timing of your life, the circumstances you grow up in that shape your financial outlook?
Totally. Even Bill Gross, this bond market legend, he admitted his success was partly due to like a perfect storm of declining interest rates during his career.
Wow.
Something that probably won't happen again.
So he is in the right place at the right time.
Yeah, for his generation, bonds were like gold, right?
Yeah.
But for his father's generation, who lived through higher inflation, bonds were probably seen as like...
Risky.
Yeah, risky.
So different generations have different financial DNA almost.
It's true. They see the same things in totally different ways.
Yep.
Like, think about the 2009 recession.
Okay.
Unemployment hit 10% nationally. But for some groups, young African-American men, no high school diploma, it was almost 50%.
Wow, that's a huge difference.
Yeah, and for older white women, college degrees, it was closer to 4%.
So even within the same country at the same time, people had wildly different financial experiences.
Exactly.
It's crazy. So if our personal history is so powerful, does that explain some of the things that seem totally irrational?
Like what?
Like someone who's struggling to make ends meet buying lottery tickets.
Oh, yeah, the logic of the illogical, right?
Exactly. Makes no sense on paper.
No.
Why would you spend money on something with such low odds of winning?
Especially when you're already struggling.
Right.
But maybe it's not just about understanding the odds.
You mean there's more to it?
I think so. For someone with limited options, A lottery ticket, it's like buying a dream.
Ah, that's interesting.
It's a chance, however small, for a better life.
Escape poverty, maybe buy a house.
Yeah, giving their kids opportunities they never had.
I see. So it's not just a financial decision, it's an emotional one.
Totally. It's about hope, even when the odds are stacked against you.
Makes you think. So we're not always as rational as we think we are.
Not even close. Our decisions are influenced by so many things: our past, our ego, our social circles.
Right. It's not just spreadsheets and formulas.
No, it's about the stories we tell ourselves about money.
The narratives we create.
Yeah, exactly.
Okay, so what's another area where our common beliefs about money might be off?
Well, let's talk about retirement.
Okay.
We think of it as this normal, expected part of life.
Yeah, you work, you save, you retire.
Right, but it's actually a pretty recent phenomenon.
Really? I always thought it's been around forever.
Not really. Before World War II, most people worked until they died.
Wow, no retirement.
Not really. Even Social Security, at the beginning, it wasn't enough to live comfortably.
Oh, I see.
Poverty among the elderly was really high until the late 60s.
So the idea of a secure retirement, it's relatively new.
Yeah, like less than a century old.
Wow.
And this whole idea of private pensions being the norm,
Yeah.
it's a myth. In the 70s, only a quarter of people over 65 had pensions.
That's surprising.
Yeah. And even then, it wasn't much money.
So this whole thing about planning for decades of retirement, saving, investing,
Yeah.
it's a pretty new challenge.
It is. A lot more responsibility on the individual.
Yeah, for sure. Okay, so when we talk about people who are super successful with money,
Okay.
there's always this debate, right?
What about?
Skill versus luck. How much of it is hard work? How much is being in the right place at the right time?
That's the million-dollar question, right?
Yeah, and it's hard to separate the two.
It is. Luck and risk, they play a huge role, but we often ignore them.
It's easier to focus on the skill, the strategy.
It is. Like Robert Shiller, this Nobel Prize economist, he asked, what do you want to know about investing that we can't know?
Deep.
And I think a big part of that is the role of chance.
Right, because saying someone's success was all luck, it sounds kind of dismissive, maybe even a little jealous.
Totally. It's like you're taking away their accomplishment.
Yeah, you're saying they didn't deserve it.
Right.
And for the person themselves, it's probably hard to accept that luck played a role.
Oh, yeah, because then it feels like maybe you didn't do enough.
Right, but it's there, right? It's got to be a factor.
It is. Like, there's research showing that siblings' incomes are more closely linked than their height or weight.
Wow, really?
Yeah, which suggests that background, something you can't control, plays a huge role in your financial success.
So where you start in life matters.
It does. But then you have people who came from nothing and became billionaires.
Right, so it's a complex mix.
It is. How do you separate a good decision that went bad because of bad luck
Yeah.
from a bad decision that turned out good because of good luck?
It's almost impossible.
It is. And we love simple stories.
Yeah, we want to believe in the rags to riches tale.
You do. But reality is messier.
Much messier.
Like, take Cornelius Vanderbilt,
Okay.
shipping magnate, railroad tycoon, ruthless guy.
Yeah.
Was his success all skill?
I mean, he was pretty cutthroat.
He was. He famously said, "Ain't I got the power?"
Yeah.
But that could have easily backfired.
Right, he was taking huge risks.
He was. And sometimes risk-taking pays off, sometimes it doesn't.
Yeah. So it's hard to know how much was him, how much was luck.
It is. Even Benjamin Graham, the father of value investing,
Okay.
most of his returns came from one lucky bet on Geico.
Wow.
And it went against his own diversification rules.
Really?
Yeah. He even questioned whether it was luck or skill.
So even the greats get lucky sometimes.
They do. It's important to remember that.
Yeah.
And it's why we should be careful about trying to copy people like Warren Buffett. Exactly.
Because we might not get the same lucky breaks.
Exactly. As Frederick Lewis Allen said, we can learn more from studying average people.
Makes sense.
And Bill Gates said, success is a lousy teacher. It seduces smart people into thinking they can't lose.
Oh, that's a good one.
When things are going great, it's easy to get cocky, right?
Yeah, you start to think you're invincible.
And that's when you make mistakes.
Big mistakes.
Yeah.
So how do you avoid that? How do you stay grounded?
I think it comes down to understanding this idea of enough.
Okay, what does that mean?
There's this story about Kurt Vonnegut and Joseph Heller.
They were at a party hosted by this billionaire.
Right.
Vonnegut's like, this guy made more money today than you made from Catch-22 ever.
Wow.
And Heller says, yes, but I have something he will never have. Enough.
That's powerful.
It is. In a world that's always pushing for more.
Yeah, it's like everyone's trying to keep up with the Joneses.
Exactly. But Heller, he was content.
He knew when he had enough.
Exactly.
And I guess that's a hard thing to do, right?
It is, especially when you see others with more.
Yeah.
Like, look at Rajat Gupta, CEO of McKinsey, super successful.
Yeah.
But he got involved in insider trading.
Oh, where?
Risked everything, his reputation, freedom, everything.
And for what? More money?
It seems so. He already had plenty.
It's like he couldn't stop chasing more.
Yeah, that's the danger, right?
Yeah.
When you never feel like you have enough.
Right. You know, it's like that hedge fund, long-term capital management,
Oh, yeah.
Nobel Prize winners, super wealthy traders.
The best of the best, and they blew it all up.
They did. Took too much risk.
Yeah.
Warren Buffett called them foolish.
Foolish.
Yeah, they risked what they needed for what they didn't need.
It's a good lesson. Knowing when to stop is key.
It's maybe the hardest financial skill to master.
Yeah, for sure. So what else is there to know about, like, the fundamentals of money?
Well, let's talk about compounding.
Okay.
Everyone talks about it, but it's hard to truly grasp how powerful it is.
It's a bit abstract. Yeah.
It is. Like, think about how ice ages formed.
Okay.
It wasn't one giant snowfall.
No.
It was small amounts of snow year after year.
Oh, I see.
Like this glaciologist, Gwen Schultz, said, it's not the amount of snow, but the fact that it lasts.
So it's consistency over time that creates massive change.
Exactly. It's the same with money.
Okay.
Consistent saving, even small amounts, can grow huge over decades.
Because of compounding.
Yeah. Look at Warren Buffett again.
Okay.
It's not just his stock picks. It's that he's been investing since he was a kid.
Time is on his side.
It is. If he'd started 10 years later, even with his amazing returns,
Yeah.
he'd be worth way less.
Wow, that's crazy.
His skill is investing, but his secret weapon is time.
Compounding over decades.
Right. And our brains, they think linearly, you know?
Yeah. We see 1 + 1 = 2.
Exactly. But compounding is exponential. It's hard to wrap your head around.
It's not intuitive.
It's not. Like how computer storage has exploded.
Oh, yeah?
It's grown so fast, it's hard to even comprehend.
From kilobytes to terabytes.
Exactly. Even Bill Gates, at first he was like, why would anyone need a gigabyte of email storage?
You couldn't see it coming.
No, because exponential growth is mind-blowing.
It is. Okay, so compounding is this slow, steady force.
Yeah.
But what about when things go bad? Recessions, market crashes, all that.
Right. That brings us to survival.
Surviving.
It's the most important word in money.
More important than compounding.
I think so.
Really?
Making money is one skill, but staying wealthy is another.
Oh, I see. You can make a fortune, but then lose it all.
Exactly. Like Jesse Livermore, made a killing in the 1929 crash,
Okay.
then lost it all, died by suicide.
That's tragic.
It is. And countless others went broke during that crash, too.
Yeah.
So surviving, staying in the game, that's what lets compounding work its magic.
Makes sense.
Think about how many companies go bust.
Yeah, a lot.
Compounding needs years, decades of uninterrupted growth.
To really take off.
Yeah, you gotta weather the storms.
The inevitable downturns.
Right, like Michael Moritz from Sequoia Capital, he talked about their fear of going out of business.
Fear.
Yeah, he said only the paranoid survive.
Interesting perspective.
It is. They're always on edge, never complacent.
So it's not just about making money, it's about not losing it.
Exactly. Sometimes the best move is not selling when everyone else is panicking.
Yeah. Holding on for dear life.
Right. Having some cash, even if it's not earning much,
Yeah.
it can save you from having to sell your stocks at a loss.
Like a
It is. And steady returns over time, even if they're not spectacular, they'll usually win.
slow and steady wins the race.
It often does. And it's not just about having a plan, it's about planning for when the plan goes wrong.
Oh, right, because life never goes according to plan.
It doesn't. The last 20 years have been crazy.
9/11, the financial crisis, the pandemic.
Yeah, who could have predicted all that?
Yeah.
So you got to build in room for error.
Flexibility.
Yeah, because life is unpredictable.
Totally unpredictable.
And that's how you survive.
Okay, so survival is key. But I guess even with the best planning, there could be bumps in the road.
Absolutely. Setbacks are part of the process.
Even for the most successful people.
Yeah, even them. It's like how the brain develops in adolescence.
Okay.
It prunes neural connections.
Like it gets rid of stuff.
Yeah, it sounds counterintuitive,
It does.
but it actually makes the brain more efficient.
Oh, I see. So sometimes losing something can actually be beneficial in the long run.
Exactly. And in investing, even the best get things wrong sometimes. Yeah, but they still make a fortune overall.
So it's okay to be wrong sometimes.
It is. It's part of the learning process.
Right, like Walt Disney.
Yeah,
His first studio went bankrupt,
it did.
and most of his early cartoons lost money
Yeah, but he kept going.
and eventually created an empire.
He did. And it's often these tail events, these rare, high-impact things that drive success.
Okay, what are those?
Like in venture capital, most of the returns come from a few huge winners.
Oh, right.
Handful of companies make all the money.
So it's not about being right all the time. It's about hitting those home runs.
Exactly. And it's the same in the stock market.
Really?
Yeah. Most companies don't do that well, but a small number become massive successes.
So for investors, it's about finding those few companies that really take off,
Yeah, and having the patience to hold on to them.
even when things get bumpy.
Even then, like there's this simulation, Sue, Jim, and Tom, they invest through recessions.
Right.
Sue invests consistently no matter what.
Just keeps buying.
Yeah. Jim and Tom try to time the market.
Oh, like buying low, selling high.
Right. But guess who ends up with the most money?
Sue.
Oh, Sue.
Because she stayed consistent.
Yeah, she rode out the ups and downs.
It's a good reminder to stay the course.
It is. Even Jeff Bezos, he talks about how failures are stepping stones.
Like with Amazon Web Services.
Yeah, it wasn't an overnight success.
They had to iterate, experiment.
They did. And George Soros, he said, it's not about being right or wrong. It's about how much you make when you're right and how much you lose when you're wrong.
So minimizing losses is as important as maximizing gains.
Maybe even more important.
Yeah.
Because one big loss can wipe out a lot of small wins.
So you've got to protect your downside.
You do. Okay, but let's shift gears for a second.
Okay.
We talk about money, wealth, all that. But what's the real goal?
What are we really striving for?
Yeah, what's the ultimate reward?
Good question. I mean, money is great, but it's not everything.
It's not. The best thing money can buy is freedom.
Freedom.
Yeah, freedom to do what you want, when you want, with whom you want.
Ooh, I like that. Like true autonomy.
Exactly. You can't put a price on that.
No, you can't.
And happiness research shows that money alone doesn't make you happy.
Right. There's more to it than that.
It's about using money to buy time and options.
Like experiences, travel, time with loved ones.
Yeah, those things are priceless.
Totally. You know, I once had this internship at an investment bank.
Okay.
Paid really well. The work was interesting, but I was miserable.
Really? What?
No control over my time. I was always on call.
That feeling of being trapped.
Exactly.
Psychologists call it reactance.
Interesting.
It's that need to feel in control of our lives.
Yeah, when that's taken away, even if it's for something good, it feels bad.
It does, and it's the opposite of financial independence.
Right, when you have enough money to choose what you want to do.
Exactly, like when I quit my job to pursue music, I wasn't rich, but I felt free.
That's amazing.
It was. And it's funny, the US is the richest country ever, but people are stressed out.
Yeah, always striving for more.
Right. And there are studies showing that elderly people, their biggest regrets are not about money.
Really? What are they about then?
It's about relationships, purpose, time spent enjoying life.
That makes you think.
It does. True wealth is about having control over your time, not just your money.
It's about living a life you love.
Exactly.
You know, it's easy to get caught up in the whole wealth thing.
Oh yeah, totally.
Like wanting a nicer car, a bigger house.
Status symbols.
Yeah, thinking it'll make us happier, more respected.
It's tempting.
But is it really that simple?
I don't think so. We often crave wealth for the wrong reasons.
Like what?
We want to be admired, liked, envied even.
Yeah, that's true. We want to fit in, maybe even stand out.
Right. But the thing is, people admire the things, not the person.
Oh, there's a good point.
Like you see someone driving a fancy car, you think, wow, nice car, not, wow, I respect that person.
Right. The car gets the attention, not the driver.
Exactly. And we think buying expensive stuff will make us more likable, but other people are just focused on their own stuff.
They're trying to keep up with their own Joneses.
Exactly. Real respect comes from things like humility, kindness.
Yeah, those are qualities that matter.
They do. And here's the irony. Real wealth is what you don't see.
What do you mean?
It's the unspent income.
Okay, like savings.
Yeah.
Yeah.
As a valet, you probably saw that not everyone in a fancy car was actually wealthy.
Oh, yeah, some are probably drowning in debt.
Right. They were spending a huge chunk of their income.
Just to maintain the image.
Yeah, and Bill Mann said it well.
What'd he say?
There's a difference between feeling rich and being rich.
I like that.
Feeling rich is spending a lot.
Yeah,
Being rich is not spending what you have and not spending what you don't have.
that's wise.
It is. True wealth is the accumulation of unspent money.
Okay, so if it's all about not spending, then saving must be the most important thing.
It's a huge part of it.
But it's hard, right? Especially if you don't have a specific goal in mind.
It is. But saving, it's like building a financial foundation.
Okay.
It's about security, flexibility.
For the future.
Yeah. And building wealth, it's not just about income or investment returns.
Okay.
It's mostly about your savings rate.
How much you save out of your income.
Exactly. Like think about the 1970s oil crisis.
Okay.
The solution wasn't just finding more oil.
No.
It was becoming more energy efficient.
Oh, I see. We needed less.
Yeah, we increased our energy wealth by reducing our needs.
So it's similar with money. Saving is like increasing our financial efficiency.
Exactly. And it's something we can control.
Unlike the stock market.
Right. We can't predict the market.
But we can control our spending.
We can. And saving, it doesn't always have to be for a specific thing.
Like a down payment on a house or something?
Right. It can just be for peace of mind, for options, for freedom.
Yeah, to know you're prepared for whatever life throws at you.
Exactly. And remember, we're not robots, we're emotional beings.
Yeah, emotions play a huge role in our financial decisions.
They do. And that's okay. You don't have to be perfectly rational.
Oh, interesting. So what's better than being
I
rational?
think being reasonable is more important.
Okay, what's the difference?
Well, purely rational models, they don't always work in the real world.
Because they don't account for human behavior.
Exactly. Like, think about Julius Wagner-Jauregg.
Who's that?
He won a Nobel Prize for treating syphilis with malaria.
Wait, what? Malaria?
Yeah, he'd inject patients with malaria to induce a fever.
That sounds crazy.
It does, right? Totally irrational.
Yeah.
But it worked. Sometimes the fever would kill the syphilis bacteria.
Wow, so sometimes being a little irrational can pay off.
It can. And it's the same with money.
Okay, how so?
Like if you're super rational, you might use tons of leverage, even after losing everything.
Because the math says it'll eventually work out.
Yeah, but that's crazy in practice.
Too risky, too stressful.
Exactly. You gotta factor in your emotions, your risk tolerance.
Be reasonable, not just rational.
Right. Like Harry Markowitz, the guy who invented modern portfolio theory.
Okay.
He just split his money 50-50 between stocks and bonds.
Didn't use any fancy math.
Nope. He said it was to minimize future regret.
So he's thinking about his feelings.